Hello and welcome to Skipton Building webinar on inheritance tax. We'll start with some introductions. I'm Carly and I'll be hosting today's webinar. I'm a business development manager and I've worked for Skipton for 5 years now. In fact, I've just celebrated my work anniversary. I'm delighted to be here with you today as I'm passionate about financial planning. I've seen firsthand from customers and my own personal experiences what a difference making a plan and getting the right advice makes to people's lives. I'm also joined by our experts, Lloyd and Louise. They'll be delivering the main part of this session. They'll also be available at the end to answer your questions. I'll let them both introduce themselves now. Over to Lloyd.
Thanks, Carly. Evening, everybody. My name's Lloyd and I've been in financial services since 1987. I first qualified in 94 to be able to give advice to clients. So I have over 27 years worth of experience. I've also been here at Skipton for 17 years. I help a lot of clients in accumulating and saving wealth, also looking at their retirement planning and mitigating inheritance tax as well.
Thanks, Lloyd. My name's Louise. I'm also a senior financial advisor here at Skipton. Been in financial services since graduating from university, doing a wide range of roles and helping clients who have been both based onshore and offshore. I cut my teeth, so to speak, working in the streets of London and found inheritance tax to be a real key issue for a lot of my customers. So hopefully today we're looking forward to giving you some help and support on the ways that you can help your parents moving forward.
Wonderful, thank you. The focus of today's webinar is to provide you with some insight on inheritance tax. Now, inheritance tax is a really important part of estate planning, and there's no doubt that as your parents do get that little bit older, you'll want to do everything you can to help them keep their finances in order. Hopefully, by the end of today's session, you'll be able to go away and have the confidence to start a conversation with your parent or parents about any potential inheritance tax liability, and if so, what steps they may wish to consider to try to reduce them. You may also be here today on your own behalf. You may be conscious of your own estate value and potential inheritance tax liability. So, whilst the information in the webinar does refer to helping a loved one, the technical information discussed remains exactly the same, whether you're looking to help a loved one or dealing with your own inheritance tax planning. In summary, we're here to help those directly affected by an inheritance tax liability. So, before we get into more detail, I just wanted to quickly explain a little bit more around Skipton and our background helping people plan for their retirement. As a building society, our roots go all the way back to 1853, and we now help over 1 million customers. We've also offered a financial advice service for over 30 years, covering advice on investments, pension, retirement and inheritance tax planning. You've come along today as you've got inheritance tax on your mind, but if there's something specific you're looking for and we don't cover it today, we'll put our contact information in the Q&A box for you to get in touch, and we really do look forward to hearing from you. So you might be thinking, what can I expect from the session today? We'll start by looking at why inheritance tax might be a concern for your parents. And then we'll look at how inheritance tax works. Louise has got 7 ways which you could reduce an inheritance tax bill. And we can see how Skipton could help you. Towards the end of the session, Louise and Lloyd will be able to answer any questions you may have. So please do feel free to ask questions as we go along using the Q&A box. You'll see that on the right of your screen, and we'll go through them at the end. I'd also like to point out that this webinar is being recorded, which is great because we can send you a copy of it via email and you can refer back to the information if you wish to speak to your loved ones after this session. I'll now pass you over to Lloyd. He'll look at why inheritance tax might be a concern.
Thanks, Carly. I'm regularly advising a lot of my clients in how to protect their wealth and to pass that on to their family. And this is why inheritance tax might be a concern. It could be your own estate or indeed your parents' estate that is subject to this. Now, this is a tax that doesn't just impact the super rich. And indeed, over the next 5 years, it's expected the government will collect over £30 billion in inheritance tax. That's a lot of money. And that money has been saved, worked hard for, by you and parents. So let's try and make sure that HMRC don't collect as much as this in the future. And the good news is that you're here to better understand inheritance tax, and we've got some real valuable insights that you can take away from today. This is so important for you to have knowledge, and it's definitely why advice is needed. So what we'll be looking at next is the tax basics. Now, there are two things certain in life: death and taxes. And since I've been giving advice, inheritance tax is regularly featuring in my day-to-day discussions. And as I've explained earlier, it's not all about the super rich, despite the Downton Abbey estate that you can see. Looking next at a typical family home, the car on the drive, the cash in the bank, the investments that are held, everything is all accumulated and added up when death occurs. And inheritance tax is typically charged at a rate of 40%. Now, everybody has an allowance which is called the nil rate band, and this is set at £325,000. There's also the possibility of an additional allowance which is called the residence nil rate band, and that's an additional £175,000. So let's look next and find out what if you're married or in a civil partnership. In most cases, married couples or civil partners can pass on up to £650,000 or £1 million if their estate includes their home going to a direct descendant. Now, in most cases, our home is our biggest asset. Please remember at this point as well that inheritance tax is charged on second death. So transfers between spouse is tax-free. I encourage all of my clients, whilst both alive, to start planning now. Now, if one of your parents has passed away, or indeed a spouse, then the need to act becomes more urgent. We'll look next at an example estate with a value of £500,000. It's therefore over the threshold of £325,000, and therefore the tax payable at 40% on this 175 is £70,000. So by seeking advice, we can help minimise or even remove that tax bill completely. Let's talk now a little bit more about the residence nil rate band that I referred to earlier. Again, looking at the estate value, this time £500,000, which includes property worth £300,000. If this is passed on to a non-direct descendant, the only allowance is the £325,000, which would therefore trigger a £70,000 tax bill. Now, when we talk about direct descendants, examples of this is children, stepchildren, and any adopted children as well. So it's really important to make sure that you know the value of your home and it's going to pass on to a direct descendant, because as you can see, that would then reduce and eliminate the tax bill to zero. So inheritance tax is often referred to as a voluntary tax. However, I'm sure no one has HMRC written as a beneficiary in their will. So what I'd like you to do is to get your calculator out and work out the size of the estate. You need to look at your house value first, then personal possessions and valuables, any savings and investments, so that's cash in the bank or stocks and shares, and then any other assets such as car, caravan, motorbike, etc. Any business assets will also need to be added on, and then life assurance policies, as in the event of death, these would pay out and form part of your estate. If, however, you have any of these death benefits written under trust, then you can subtract that amount from the calculation. This will then give you your total gross assets. And just remember, have you included all of your joint assets with your partner and also subtracted any debts such as mortgage, personal loan, credit cards, etc. So check your allowances and find out how much is the tax bill. What will HMRC stand to benefit from your estate? So we're going to look next at 7 ways in how you could cut an inheritance tax bill. We want to give you focus, we'll give you clarity, but it's so important for you to know what your problem is. We ultimately want to make sure that more stays in your family's pocket and less to the taxman. By sitting down with a financial advisor from Skipton Building Society, we'll be able to tell you all of the options. I'll now hand you over to Louise for herself to tell you ways in how we can cut this inheritance tax bill.
Thanks, Louise. Thank you for that. So the first thing you can do is to make a will. It's an absolute key part of all estate planning, and it really gets the basics in place. A will can prevent parents or your own assets from being distributed incorrectly. It gives you that rite of passage to say, these are my wishes and this is what I would like to do. Without a will, your assets could be distributed according to intestacy rules and therefore could also be liable to inheritance tax. Otherwise, this could have been avoided. If you haven't, or your parents haven't put a will into place yet, it's really important as the first step to take. I'm absolutely delighted to tell you that we do have a will referral service here at Skipton, and we'd be happy to arrange a will that's tailored to your parents or your own wishes. It's also really worth noting that it's important to keep your existing wills up to date. And ideally, it's a good idea to look at them every 2 or 3 years, just to make sure it's still in line with current tax rules, legislations, but to make sure it's doing what you want to do. Has there been changes in family, new grandchildren, etc. Make sure your wishes are put down on paper. The second thing that we can do, and this comes a little bit as a surprise for people, is you can actually use your pensions. These can be passed on to spouse, children, grandchildren, tax-free. That's right, tax-free. However, there is a caveat. This is only the case if the person was to die before the age of 75 and the pension is worth less than the lifetime allowance. However, with this option, it gives the beneficiaries the spending power to do what they want with those funds without incurring a tax bill. They don't need to be over 55, which is the normal cut-off age for taking a pension. Just to let you know, however, if you were to die over the age of 75, the remaining fund can still be used by the members of your family. However, when they do take that money out, it will be treated as income. Now, it could mean that they'll get less back, but they'll pay income tax, which could be less than if they paid capital gains tax. And there are some older style pensions out there which could be classed as part of your estate and therefore might not be able to be passed on from inheritance tax. Now, there are a wide range of other tax considerations to think about when saving and withdrawing from a pensions, and we would always recommend that you speak to an advisor to check these out and see how they affect you personally. The next thing to consider is what we call the gift of gifting. So gifting money as a loved one, it's a great way to help reduce your inheritance tax liability. Now, each year, you yourself and your parents have the option to gift £3,000 without this being counted as part of their estate, and it's known as the annual gift allowance. There's also a really big positive with this, which is you can actually carry forward unused parts of your allowances in the following tax year, but only for 1 year. So this gives you the maximum total of £6,000. Now, this allowance is available per person, so a couple can actually use their combined annual allowances if they so wish. So if I was to look at a quick example, let's have a look at a quick example of a £3,000 gift allowance and what that could save on inheritance tax. So we've got a period of 5 years. The gift allowance comes to a total of £15,000, okay? So let's say that this £15,000 forms part of your estate. And this is over the 325,000 threshold. Now, typically that's going to be taxed at 40%. And this would therefore mean the beneficiaries would see £9,000 of this. However, if it was gifted regularly, they would receive £15,000 of this. So it demonstrates to you that some good planning and some good gifting, you can actually save a significant amount of money. Now, there's also some good news to let you be aware of when someone's big wedding day is coming up. Weddings and civil partnership gifts have a slightly different allowances, and they are exempt for inheritance tax. You can do £1,000 per person, £5,000 for a child, £2,500 for a grandchild or great-grandchild. And this is in addition to the £3,000 annual gift allowance that I've just mentioned. You're also able to give yourself and your parents up to £250 to any number of people each tax year, tax-free. But just remember, they can't have used this in another exemption on the same person, okay? There's also what's known as making gift from your surplus income. So if you or your parents have enough income to maintain their usual standard of living, they can actually set up regular contributions into someone's savings accounts or annual payments on birthdays, etc., etc. But it is really, really important to remember that these gifts need to be maintained and they need to be evidence to say that they are surplus of income. What we say to everyone is, if you're unsure, please speak to the person that's going to be able to help you. So the next one is what's known as a pet. Now, sadly, these are not the soft, fluffy things that we have in our homes on a daily basis. They are what's known as a potentially exempt transfer. And what this means is they do have the potential to become exempt. However, there are rules attached to this. So you are allowed to make a gift of an unlimited value, okay? And these are the ones that exceed the £3,000 annual allowance. However, there's a but. There's always a but. These gifts can only become exempt from inheritance tax if you or your parent survives for a period of 7 years after making the gift. Now, if unfortunately you weren't to survive the gift by 7 years, the transfer may become subject to inheritance tax, hence why they're called potentially exempt. If you or your parents pass away less than 3 years after the transfer is made, it is likely that the full 40% tax charge would apply. And then gifts that are made between 3 and 7 years move on a sliding range, as you can see on the chart there, from 32% down to 8%. Now also, just to make things slightly more complicated, it is important that the gift or the total value of gifts are above the individual's inheritance tax threshold in order for the tax relief to apply when they do pass away. Now, as you've probably gathered, when it comes to gifting or inheritance tax, there are options to consider, which is the great thing, but there's also a lot of varying rules and a lot of information to take on board. It's really important you keep a record of these gifts, but it's also why expert advice comes in really, really handy. And it's why something which we are advocating and showing to you today that myself and Lloyd and the rest of the team at Skipton really want to help and give you that advice moving forward. So moving on to number 5. So number 5 is leaving a charitable donation. So if you've got a charitable cause that's really close to your heart, not only can you leave a donation in your will, but you can actually use this to help reduce your inheritance tax liability. Anything that is left to a registered charity is free from inheritance tax. But if you were able to leave at least 10% of your total assets to charity, then actually you get a reduction on the inheritance tax rate from 40% to 36%. So looking at the example that's on there, so say you or your parents leave an estate and it's valued at £425,000. You've got your £325,000 threshold, and that makes £100,000 of this estate taxable. And this would result in an inheritance tax bill of £40,000. However, you want to leave £10,000 of this estate to a charity of your choice. 10% is £10,000, which equates to the £100,000 that is going to be left over the inheritance tax threshold. And as 10% of the estate's been left to charity, the estate would now only pay 36% on the £90,000, meaning that the inheritance tax bill would become £32,400. So you've saved £7,600 off your inheritance tax bill. Now, I can know what you're all saying. I do get this. It is complicated. It does also mean that the beneficiary gets slightly less, but it does mean that the charity wins. There is a win-win situation because you're leaving money to charity, you're leaving money to beneficiaries, and you are reducing your inheritance tax state. Now, as a caveat, rules are not always quite as simple as what I've just described, which is why you're probably going to guess what I'm going to say to you. When it comes to inheritance tax, it's always a good idea to seek advice, and myself and my colleagues will be delighted to help you with that. So moving on to the next thing, so number 6, you can be putting your assets into a trust. So when you put money into a trust, technically you don't own that anymore, and therefore it doesn't form part of your estate. However, there are advantages and disadvantages just for us to talk about. A great advantage of a trust is it gives you a way to keep a degree of control, gives you an idea as to letting you express how you want the trust to work. It avoids handling excessive amounts of money. It gives beneficiaries time to grow up, or maybe they're in a vulnerable position right now and just need some additional time and support. It's down to your parents or yourself to set the rules. You get to decide what the rules are. So you could say, right, I'm going to put this money in trust for my grandchildren, but I'm going to set it up so actually they can only get access when they're older. And to you, that could be 21, it could be 25. But it means that you get the rules in place when you first put the trust in place. Now, there are several types of trust available, some of which you can see I've listed, and it would take me a significant amount of time to delve into each one properly today. But I just want to say you can use a trust, but please, please, please be careful when looking at opening up trust, because it does have other tax charges that could prove to make the inheritance tax the very, very least of your problems. So what we say is the type of trust is really, really dependent upon your own needs, your goals, your needs, your aspirations. So what we will do is listen to what your parents want to achieve and then give you the right solution. Okay. So that leads really nicely on to number 7. Let us find the right solution for you. Our expert team are here to help all of those that are directly affected with a potential inheritance tax. And we have a real key 4-step approach, and this allows us to make tailored plans designed to suit you and you specifically. So the first step, we are going to be talking to you. We're going to be finding out what's important to you, why that is important, and what does that mean. Step 2 might sound a bit straightforward, but we're really going to understand what your inheritance tax liability is. What does that look like and why? Step 3, we're going to present you with your own personalised plan. How can we be putting the right things in place to help you stop paying the taxman? What can we do and how can we achieve that for you? And step 4, we'll put all of the forms and bring that plan to life. Okay, and I do need to let you know that some solutions you are putting your capital at risk, but it is always the right thing to do to speak to an advisor, and I know firsthand myself and Lloyd would be delighted to help. So if you think that we can help, I'm going to hand you back to Carly, who's going to explain to you the ways in which you can do that.
Thank you, Louise. Now, although inheritance can be complicated. We hope you're feeling more informed about the steps your parents could take as part of their inheritance tax planning journey. As we've mentioned several times during today's session, speaking to an advisor could make all the difference when it comes to your parents' estate. We've a dedicated team of financial advisors who are here to help people make informed decisions when it comes to their legacy planning. There's no one size fits all from us. We offer a range of solutions for a range of different people, needs and circumstances, so you can feel confident that we only act in your parents' best interests. And how will we do this? Well, we'll take the time to get to know your parents. Our advisors work hard to build long-lasting relationships and provide solutions which not only could work now, but also in the future. There's no pressure to act or upfront fees to pay. Your parents will only be charged if they decide to act on our recommendations. Plus, any charges are clearly outlined beforehand. We've already helped many people make plans for an inheritance tax liability. Take Tanya, a teaching assistant from London. She recently contacted us as she needed help considering how inheritance tax would affect her family. With our advice, she set up a plan that allows her to leave behind a legacy for her loved ones, and in the meantime, her wealth can provide an income to support her lifestyle. Here's what she had to say. I wanted to generate an income for me, but one that wouldn't take me over my inheritance tax threshold to help my sons avoid having to pay any inheritance tax. We talked about trust funds, generating an income and still leaving behind money for my sons. I feel that with Skipton, my needs have been met, and I think the advice given to me has been balanced and proved very correct. So, as we come to the end of the session, and before we move on to our questions, here's a reminder of how you can get in touch with us. By phone, and you can see the number on screen. Feel free to write it down. You can use the callback form and the links in the Q&A bar. You can also continue the conversation via web chat, or if you've got a branch locally, you can pop in and chat to one of our colleagues. So I guess just to finalise, if you or a loved one is directly affected by an inheritance tax liability, then we really want to hear from you. Louise and Lloyd will be around after the session if you do want to continue the conversation. And our experts who will take your calls will be available this evening till 8 p.m. Thank you for joining us. I really do hope you've enjoyed this session.